In this lecture, we will go over the CFA Level 1 reading on international trade and capital flows. Here are the sections in this reading: international trade, restrictions and agreements, balance of payments, and trade organizations. Let's start with section 2, which gives us an overview of international trade. We'll go over some basic terminology, talk about the patterns and trends in international trade, the benefits and costs of international trade, this is important, and then comparative advantage and the gains from trade. This is also very testable. Basic terminology: GDP and GNP. In the previous reading, we talked about GDP, or gross domestic product. This is the final market value of all goods and services produced in a domestic economy. GNP is slightly different. With GNP, we also consider the income or the output of foreigners in the country, and we subtract that out of GDP. And then the income produced by nationals of this country who are abroad, that income is considered and it is added to come up with GNP. So if you are to come up with a very basic equation or relationship, GNP is equal to GDP minus the income of foreigners in this country plus the income of citizens of this country who are outside the country. There will generally be a difference in GDP and GNP for countries like Pakistan, where a large number of Pakistanis are working abroad. Next piece of terminology is terms of trade. This is simply the price of exports divided by the price of imports. And here the price is based on an index. We don't need to get into details here, but the high level point is that if this ratio goes up, then that means that there is an improvement in the terms of trade, because this ratio is telling us about the price of exports per every dollar or every unit price of imports. If this ratio was originally 1.1 and from 1.1 it goes up to 1.3, this means that the price of exports is going up relative to the price of imports, which is an improvement from the perspective of a particular economy. Trade surplus and deficit, we have talked about this briefly before. If a country has high exports relative to imports, then we say it has a surplus. Otherwise, the country has a deficit, and we'll see this in more detail over the rest of this reading. Autarky. Here is a term that you might not have seen before, and autarky is closely related to what's called a closed economy. If you have a country which does not trade with the rest of the world, it produces goods and services, and then the goods and services produced in this country are also consumed in the country, then we say that we have an autarkic state and the economy is closed. Closed in the sense that it does not have any trade with the rest of the world. No imports, no exports. The opposite of autarky is free trade, and with free trade we have an open economy. If we have a given country, and this is the rest of the world, free trade means that this country trades freely with the rest of the world. It easily sells goods and services to the rest of the world, and goods and services from the rest of the world easily come into this country with little or no restrictions. Trade protection. Even though there might be trade with the rest of the world, at some point or some countries put some trade protections. For example, some countries might impose tariffs or quotas to encourage local exporters. There might be export subsidies, and these are items that we will cover later in the reading. FDI MNCs, FPI, these are a few other important terms. FDI stands for foreign direct investment. With foreign direct investment, companies or entities from the rest of the world invest in our domestic country and build factories, for example. These are investments in actual companies or investments where there is a certain amount of infrastructure involved. A classic example would be if you have a German company that builds a textile factory in India, that would be an example of a foreign direct investment. And typically it would be multinational companies that engage in foreign direct investment. FPI stands for foreign portfolio investment. So if an investment management company in America puts some money in the Indian stock market, that would be an example of FPI or foreign portfolio investment. Section 2.2 talks about patterns and trends in international trade and capital flows. The curriculum says a fair amount in this section, but I will summarize the main point, which is that over the last few decades, trade or global trade has increased substantially. If we look at the overall world, in this time, in the 80s, 1980 to 1989, the trade as a percentage of GDP was approximately 37.2%, and in this period 2000 to 2006 that number went up to over 50%, which is a substantial increase. And if we look at the graphs here on the left, which show trade as a percentage of regional GDP, and if we look at this solid line which represents advanced economies, then this number is increasing. So you see the number going from approximately 25% to over 40%. That is the main point here. And another larger point related to this reading is that there is a tremendous amount of detail which I will not be covering in this particular lecture. What I will do is go over all the sections but emphasize the points which I think are most testable, and I will do that based on the learning objectives and the sorts of questions that I see in the curriculum and in mock exams. Moving now to 2.3, benefits and costs of international trade, and this is quite testable, so you need to remember the benefits and the costs. The big benefit of trade is that countries gain from exchange and specialization. If a given country is good at producing cloth and another country is good at producing machines, then it makes sense that the country which is good at producing cloth specializes in this area and then exports cloth to another country. Whereas the country which is good at producing machines should focus on this particular industry and then export machines to the other country. When we talk about gains, what we mean is that for a given country, there is a higher price for exports relative to selling internally. In other words, if this particular country sells clothes internally, there is a certain price that is received. But if this country sells clothes in the international market, then it receives higher prices. Also, with imports, if this particular country imports machines and can get machines at a lower price when it imports relative to producing internally, then that also is a benefit of trade. So if either of these two situations occur, then we say that a country is benefiting from trade. As might be obvious from this discussion, industries experience greater economies of scale. If a country develops its clothes industry further, it is already good at producing clothes, but it expands this industry, then the costs can go down further due to economies of scale. Household and firms have greater product variety. If material, goods and services are coming from other parts of the world, then clearly consumers have more variety and hopefully lower cost also. competition is increased and resources are allocated more efficiently. When there is competition, then companies in a given country are also competing with companies in the global market, and that will force companies to either become more efficient or go out of business. There is greater employment in exporting countries. There will be, in this example, more employment in the clothes industry because this industry will have expanded. What are some of the costs? There is the potential for income inequality, both within a country and across countries. People in industries that are doing well will tend to get higher income, and also countries that are good at exporting material, they have more efficient industries and export more. The income of those countries will increase faster than the income of countries which are not as good at creating goods and services. There will be a loss of some jobs because less efficient firms will be forced to exit. If we take this country which is good at producing clothes, then the industry over here that produces machines will suffer. And we'll see this in examples later. For now, if you have time, take a look at example 1. This example deals with the US textile industry. This is the example that I want you to focus on though, and we will actually do it together. This is example 2 from the curriculum, and this material is quite testable. Consider two countries that each produce two goods. Suppose the cost of producing cotton relative to lumber is low in cotton land, is lower in cotton land than in lumber land. And just to visualize this better, here are the two countries. This is cotton land, this is lumber land. Initially, we have a cotton industry here and a lumber industry. And here also we have a cotton industry and a lumber industry. But as you can imagine, the cotton industry here is very strong in the sense that this country is good at producing cotton. The cost of producing cotton is relatively low. This country, lumberland, is good at producing lumber. The cost of producing lumber is relatively low. Initially, both countries produce cotton and lumber and then consume internally. But what will happen if these two countries start trading with each other? How would trade between the two countries affect the lumber industry in lumberland? If these two countries start trading, then clearly lumberland will start exporting lumber to cottonland because this country can produce lumber at a lower cost. So the lumber industry will grow. What about the lumber industry in cottonland? This industry will actually shrink because lumber is now coming from lumberland. What would happen to the lumber industry workers in cottonland in the long run? In the long run, people from this industry would have to be retrained because this industry is shrinking. So these people would have to be trained to work in the industry that is actually doing well. And that industry is the cotton industry. Not explicitly stated here, but you can see that cottonland will start exporting cotton to lumberland. So this particular industry is going to do well. This is an important question. What is the meaning of the expression gains from trade? Gains from trade means that overall the two countries are better off. If you think about the consumers in both countries are now getting better cotton and better lumber. But this does not mean that everyone or all stakeholders are better off. Clearly those in the lumber industry in cotton land are not better off, at least in the short run. And those who stay in this industry in the long run will have lower incomes. Similarly, those who stay in the cotton industry in lumberland are also worse off. So again, I emphasize, gains from trade does not mean that everyone gains. It means that on average, the countries gain. What are some of the benefits from trade? And here you can regurgitate material that we saw on the previous slide. And I will just read out a basic segment from the curriculum. And I also want you to read the solution from the curriculum. I have covered the main points, but it would still be useful to go through this example in the curriculum. For question 5, the curriculum points out that there are gains from exchange and specialization based on relative cost advantage. There are gains from economies of scale as companies add new markets to their products. There is greater variety, greater efficiency, and so on. In any case, these are items that you need to remember because this material is testable. Comparative advantage and gains from trade, another very testable item. We need to understand here the distinction between what's called absolute advantage and comparative advantage. Country A has an absolute advantage over country B, which is a trading partner, in producing machinery if country A can produce machinery at a lower cost or use fewer resources. This example illustrates a few points. When we talk about absolute advantage, we are comparing two countries in the context of a particular good or service. And this definition is fairly straightforward. If A can produce machinery more efficiently, i.e. at a lower cost or with fewer resources, then we say that A has an absolute advantage. What about comparative advantage? Country A has a comparative advantage over country B in producing machinery if country A can produce machinery at a lower opportunity cost. The critical difference between these two statements is this phrase, opportunity cost. And to understand opportunity cost, let's look at example 3 in the curriculum. This is another simple but extremely useful example. Suppose there are only two countries, India and the United Kingdom. India exports cloth to the UK and imports machinery, and the output per worker per day is shown over here. This little table effectively gives us the productivity of both countries with respect to machinery and cloth. We are asked the following questions. Which country has the absolute advantage in the production of machinery, and does that country also have comparative advantage? If we look at the UK, then it produces 4 machines per worker per day, whereas India produces only 2 machines per worker per day. Clearly, the UK is more efficient, therefore the UK has the absolute advantage. What about comparative advantage? To understand comparative advantage, we need to come up with opportunity cost. And opportunity cost will involve a simple division exercise. So you will do either 4 divided by 8 or 8 divided by 4. And many students get confused about what to do. So I will tell you how to solve this. When we are looking at the opportunity cost for machines, remember 2 things. Number 1, whenever you have the cost of something, then it should be for 1 unit of that thing. That thing here is machines. So what is the cost of 1 unit of machines? We are talking about the cost in terms of cloth. Since this is an opportunity cost, we need to compare machines and cloth. To have 1 unit of machines, you need to have the number for machines in the denominator. Remember, whenever you have a fraction, the denominator represents 1 unit. So to have this 1 unit, you need to have machines in the denominator. So you put 4 over here, 8 over here, and you get 2. So the opportunity cost of machines is 2 units of cloth. What this means is that in the UK, if you do not produce 1 machine, if you give up 1 machine, what you will get is 2 units of cloth. So the opportunity cost of machines in the UK is 2, whereas the opportunity cost of machines in India is 16 over 2, which is 8. In other words, if you give up 1 machine, you can make 8 units of cloth in India. So when you look at opportunity costs, clearly the opportunity cost of producing machines in UK is much lower than the opportunity cost of producing machines in India. That number is 8. So in terms of comparative advantage, we can say that the UK also has a comparative advantage relative to India in producing machines. Now you can do the same exercise for cloth and figure out which country has the absolute advantage and which country has the comparative advantage, and then you can go through the solution in the curriculum. In case you don't have the curriculum easily handy, the quick answer would be that India has both the absolute advantage and the comparative advantage with respect to cloth. So if the two countries trade, clearly it makes more sense for India to specialize in cloth, the UK to specialize in machinery, and then India exports cloth, imports machinery, the UK exports machinery and imports cloth. This slide demonstrates the gains from trade. The curriculum gives a lot of detail and you can go over those details if you have time, but here is the main point. On the left, we are shown the autarkic production and autarkic consumption. This would be the production and consumption assuming no trade. And notice that in this scenario, everything that the UK produces is also consumed by the UK, and the same holds for India. The total production of machines and cloth is given right here, and again the production and consumption would be the same. In a post-trade world, notice what happens. The number of machines produced in the UK is up. That increases from 200 to 400. The consumption is also up. What about cloth? The UK here is not producing any cloth, but it is now able to consume more cloth because it can get cloth cheaper from India. As far as India is concerned, it stops producing machines and now gets machines from the UK because it can get machines cheaper. And notice that the consumption of machines is up by 60. As far as cloth is concerned, now the production has increased substantially from 800 to 1600, and the consumption has also increased. So in a world where there is trade, the consumption in both countries has gone up. So we can say that both countries overall are better off. Here is another point to consider, which is related to prices. A country's gains from trade are more if terms of trade are closer to partners' autarkic prices than to its own autarkic prices. And I emphasize this here because when countries trade, then obviously there is a certain amount of gain, but how much is that gain? Let's go back to some terms that we saw earlier. Terms of trade was basically the price of exports divided by price of imports. We've already talked about this concept of autarkic prices. To understand this, think about India and UK. India is exporting clothes. If the average price of clothes in India is say 5 rupees, and the same clothes can be exported to the UK and the price of clothes here is £5, which is substantially more than the price in India, then obviously India will benefit a lot when it trades with the UK. So notice in my example, the autarkic prices of clothes are much higher in the UK relative to India. So when India exports, it can export at a price much higher than the domestic price, and clearly then India will benefit. There are other ways of looking at this also, but now that you have understood one scenario, I would suggest that you remember this statement. Here is a graphical depiction of gains from trade. The curriculum spends a fair amount of time on this material, but I will just give you a summary because this material is not emphasized in the learning objectives or in the practice problems, and you will see this content at level 2. So I think the probability of being tested on this at level 1 is low, but nevertheless, I'll just say a few important things. What we are looking at here, these dark lines are called the PPF, or Production Possibilities Frontier. If we look at panel A, which is the UK, if the UK puts all its energy in producing clothes, then it will produce this many clothes and no cars. If the UK puts all its energy in producing clothes, then it will produce this many clothes and 0 machines. As the UK gives up the production of clothes, it will start producing some machines, and as we keep going to the right, the production of clothes goes down and the production of machines goes up. Notice over here, if all the energy goes in the production of machines, then the UK can produce this many machines and no clothes. So this is a production possibilities frontier which is showing the trade-off between clothes and machines. If there is no trade, then the consumption would also have to be based on the PPF. A similar picture is shown for India, and just graphically these pictures depict that India is better at clothes and the UK is better at machines. For India also, if there is no trade, then the consumption would also have to be on the PPF. But if these two countries do trade, then the consumption can be outside the PPF, and when we are outside the PPF, then the utility is more. So that is another way of illustrating that trade will benefit both countries. The last part of this section deals with the Ricardian model and the Heckscher-Ohlin model, and I would suggest that you learn all the points that I make on this slide. First, let's talk about the Ricardian model. To understand the Ricardian model, let's consider first what Adam Smith said. Adam Smith said that we should trade if we have absolute advantage. In other words, if our cost of production is lower or if we are more efficient, then we should trade. But David Ricardo built on that and said we should trade even if we have a comparative advantage. And this is important because what Ricardo is saying is that if you don't have an absolute advantage but you do have a comparative advantage, then it still makes sense for you to trade. The next important point is that in the Ricardian model, labor is the only variable factor of production. This does not mean that capital does not exist. Capital is there, but in this simplistic model, we assume that capital is fixed. And according to the Ricardian model, it is the differences in labor productivity which are the key source of comparative advantage. So remember these points. We don't need to get too detailed into this model. As long as you know this, you will be in good shape. What about the other model? That is called the Heckscher-Ohlin model. In this model, both capital and labor are variable. And how is that different from the Ricardian model? In the Ricardian model, only labor was variable. Goods produced with varying combinations of labor and capital. So this is just an implication of the first point. Given that both capital and labor are variable, a given good can be produced with different combinations of labor and capital. Differences in the relative endowment of these factors are the source of comparative advantage. If we go back to our UK and India example, what we are saying here is that if a country is well endowed with a certain factor of production, for example, let's say that India has a high amount of labor, then it makes sense for India to focus on industries such as the clothes industry, which is very labor intensive. And it makes more sense for the UK to focus on industries which are more capital intensive, assuming here that the UK is better endowed in capital relative to India. This model allows for income redistribution through trade, in the sense that if you take India and the clothes industry in India develops, then the labor in India which is working in this industry will become richer. The income levels will go up. And the final point, which might be testable, is that in this particular model, the Heckscher-Ohlin model, technology in each industry is the same across countries but varies between industries. What that means is, if you have the clothes industry in India or the clothes industry in the UK, the assumption of this model is that the clothes industry uses the same technology regardless of which country that industry is in. However, a different industry such as the machines industry can have a different technology or different levels of technology relative to clothes. So again, technology in each industry is the same regardless of which country the industry is in, but technologies can vary across different industries. Here are the sorts of questions that you might see related to the two models that we just talked about. And this is a test of your short-term memory. On the actual exam, you will have MCQ options which will help jog your memory, but I'm not giving you those options right now. What determines comparative advantage in the Ricardian model? And we just talked about it. It is labor productivity which determines comparative advantage in this particular model. What is the relationship between gains from trade, terms of trade, and autarkic prices in the Ricardian model? And we talked about this a few slides earlier. The gains from trade are high if the terms of trade are similar or closer to the autarkic prices in the trading partner. In other words, if you have India and the UK, and the terms of trade which are an indication of price of exports over price of imports. If India can export clothes at prices that are closer to the price of clothes in the UK, which is the autarkic prices of clothes in the UK, then India has more to gain from trade. According to the Heckscher-Ohlin model, which factor benefits from free trade, the abundant factor or the scarce factor? And here the larger benefit goes to the abundant factor. If the abundant factor in India is labor, then trade means that there is more work for labor intensive industries, which means that this particular factor will benefit.